February and early March. Of course, remember that was where Russia invaded Ukraine. We had surging inflation at 9%. The Fed's going to be hiking rates. Everything is terrible. Exactly the same thing you're feeling now. You felt there back in late February, and then March has this monster reflexive rally and got back above the 200-day moving average. Was actually pushing towards, actually getting back to all-time highs. And this seems like months ago, right? But this is just March. This is just now the beginning of May here. So just a month or so ago, we have this monster rally of the markets under the very same type of conditions that we have right now. So that's my point here, is just be careful getting too far off sides in your portfolio in one direction or the other, because use the rallies when you get them to rebalance risk. Try to avoid that emotional pressure to do things when you have markets very oversold and very extended and very negatively biased to the downside. Again, when you're seeing markets in turmoil, and this is actually a chart that we have inside of our daily commentary on the website. So if you go to realinvestmentadvice.com, just click the banner right there at the top that says daily commentary. There's a chart in there right now showing the history of every time the CNBC runs markets in turmoil, markets are generally up several months after that. So, but that's just feeding into that emotional psychology that happens in markets. But again, this morning's going to be a really rough open coming right out of the gate. Bitcoin's down about 5% this morning. Ethereum's down about the same amount. So we're just seeing really just this kind of capitulatory selling really pretty much across the board. And that's going to add to that pressure this morning that, you just kind of want to sell everything and walk away. Just be careful with that. Again, there's nothing wrong with it. If that makes you feel better and takes the pressure off of you, that's okay. There's nothing wrong with selling and just going to cash if you need to do that. But it typically tends to be the worst decision longer term because of the impact, the psychological impact of that. Once you're out of the market, great, you feel better right now, but then you can't figure out how to get back in the markets either. So this is really one of those challenging moments in that you have to work through and try not to let those emotional biases lead you to make decisions that longer term even have a bigger impact on your portfolio. Look, this is going to be very tough today. It's probably going to be tough this whole week. We've got inflation data coming out tomorrow. That's expected to still be high here, but there is some signs. We'll talk about this after the break. There is some signs that we may be starting to see the peak of that inflation kind of behind us, and we'll talk about some of those indicators as well. So stick around. More of the Real Investment Show coming up right after the break. Get by the website, realinvestmentadvice.com. Get our daily commentary. That chart I just talked about is in there. Of course, all of our articles and our recent newsletter on the website as well. realinvestmentadvice.com. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. Of course, this past weekend, Mother's Day. And the interesting survey that was out. So they surveyed people from countries all over the world, and they asked them the question is like, do you celebrate Mother's Day because you want to or because you have to? And it's surprisingly in the U.S., it's still in the favor. I think it was like 57% people say because they want to, but there's a rising contingent of people that feel forced to celebrate Mother's Day because of commercialization, right?
Oh, okay.
Hallmark
Yeah.
cards
Yeah.
and commercials and peer pressure. Yeah, peer pressure is a terrible thing.
For your mom?
I know you would think so,
That's
right?
awful.
I know, right? But you go into like a Walgreens, right?
Yeah.
And there's like Mother's Day stuff everywhere.
Oh, yeah.
And, cards, and it's just like, I'm not going to buy it for mom. She's not worth it. She's not worthy.
And that stuff's been out there since Valentine's.
I know, right? So, but it is interesting. Actually, a lot of other countries around the world, they ranked in the majority of the have to category versus the want to category.
Interesting.
Yeah. So,
Well,
moms.
Without moms, they wouldn't be here.
Well, not according to the woke people.
Yeah.
We can get into that whole story later.
We could, yes.
We won't, but we could.
What is the pronoun of the day?
Markets. So let's see, what clip did you give me this morning? If you take all of the marshmallows out of a box of Lucky Charms, are you left with a box of Purina cat chow? Pretty much.
Pretty much.
Yes.
Yeah.
This is a true fact. In fact, I don't really understand Lucky Charms.
The marshmallows really aren't all that good.
I know, right? See, as you get older, you move away from those. Remember, because when you were growing up, it was Captain Crunch, it was Fruit Loops, Apple Jacks.
Alphabets.
Yep.
Yep.
That was another one. And now it's Raisin Bran, Cheerios.
I do the raw oatmeal thing.
Raw oatmeal. Yeah, I know, right? So it's like, all the fun stuff in life. Once you move out of sugary cereals, your life is pretty much over.
That's the marketing post.
That's it. So anyway, a couple of things this morning. Talking about inflation. So this week we're going to get the inflation data out for April. And, people are still expecting that inflation is going to be relatively high. And again, there's not much, worry about that being the case. That's absolutely going to be the case. We're still going to be seeing, an 8% plus print. However, there are some indications that maybe we will start to see that begin to moderate for a couple of reasons. One, we're now comparing April to April. Again, an important point here, as we've talked about this before, is that just because inflation falls in terms of how we report CPI does not mean that prices are getting any cheaper for you at your household. These are two different functions. As I've explained before, if gasoline prices at the pump, you go to the pump and you're paying $4 a gallon for gas last month, and a year from now, you're still paying $4 a gallon for gasoline. The price of gas didn't change for you, but inflation is now zero on that item because we measure it on a year-over-year basis. And this is part of the confusion that we have about inflation and the way people think about it. There's often a lot of pushback against the economic data saying it's crazy that we're running, 1% inflation. Have you seen the cost of insurance or this or that or the other thing? And the inflation for households has for decades now, last couple of decades, been much higher than what the reported inflation rate was. And this is because of the way we run mathematical calculations. It's the adjustments that we make relative to the index, how we account for things. And there's been an intentional move by government to suppress the rate of inflation because it's what affects Social Security payouts. However, the differential between the reported CPI and what people live with have been and remain two very different things. And also just remember that the whole inflation calculation is somewhat kind of useless on many degrees because, again, inflation in Texas, as an example, is very different than inflation in California. Inflation in Houston, Texas is different than inflation in Austin, Texas. So it has a lot to do with where you live. It has a lot to do with how you live. Your personal rate of inflation can be very different than what is actually reported in the mainstream media. Where you live, how you live, what you consume, those all are an impact on your personal rate of inflation. Again, so when we're taking a look at CPI and we're saying, well, the CPI was up 8% or whatever it was last month, that could be a very different number for you. But we're trying to, what government numbers are trying to do is just try to get a sense of the trend of direction overall and use that for making, calculations for Social Security, et cetera. But again, when you talk to the average person, they will, and this has been the argument for quite a long time, is that, inflation doesn't reflect the inflation they live with. In fact, there was a interview about 10, 11 years ago now with Bullard, and somebody asked him, it's like, well, how do you justify, inflation? It's like, well, the price of an iPad is about the same that it was last year, but it's a lot more powerful. So, it's actually deflation. And somebody quit back, well, you can't eat an iPad. And that's right? It's, again, it's what, it's those things you consume at home. And inflation is certainly impacting households right now because of higher gas prices, higher energy prices, higher food prices. Consumer credit card debt, as a good example of this, had fallen sharply in 2020. Because all of a sudden, all these people got these $1,400 checks from the government and these extra benefits for unemployment and all these type of things. So households had a lot of cash, disposable income coming in from the government, and they paid off credit card debt. Unfortunately, those payments are now gone, so they don't have that ability to pay off credit card debt. And inflation has now skyrocketed because of all that monetary input, and credit card debt has now surged back to the peak of where it was in 2020 before the pandemic. And the point about that is that consumers are having to resort to credit to make ends meet. That free money is gone, the cost of living has gone up, and wages aren't keeping up with the cost of living. So all of a sudden, we're to the point to where the only outcome or the only option for individuals is to opt for credit card debt in order to pay the bills, right? Going to the gas, get gas, you got to put that on a credit card, got to, put food on credit cards, groceries, etc. And so those credit card balances are running right back up. Well, the problem with that is that increase in credit card debt has been supporting economic growth over the last couple of quarters. We saw these really good numbers in the fourth quarter. We had 5.5% economic growth, et cetera. Consumer spending holding up very well. And this has been some of the reports that we've seen here lately on the economic data. It's like, well, consumers are hanging in there. Well, they were, because they were all going back into credit card debt. The question is how much more credit card debt do they have access to than they had before? which is going to be the impact of how much more they can spend before they max out those credit cards and say, well, now I don't have any choices. I only have my income and my credit cards are maxed out and I'm financially stressed out, and this is going to be an issue. And unfortunately, a lot of the money that young investors had in markets back in 2020, 2021, a lot of that's now gone as well. So the important thing about inflation here, and this is my point, is that we're about to hit that kind of wall. And maybe we've already starting to see some signs of that, as I said before the break, that there's some areas that we're looking at that are already starting to show some signs that inflation may be approaching that peak. Used car prices, as an example, which has been one of the contributors to higher inflation data, has been falling over the last month or so. And that's simply just a function of that we've now gotten to the point that people are going, well, I just can't afford to buy a used car. It's just ridiculous. A good example of this. So I drive a 1999 Toyota 4Runner. When I bought it, I buy used vehicles. So when I bought it for about $18,000. And I got a letter in the mail from Toyota yesterday saying that my truck could be worth more than what I paid for it. If I was interested in selling my Toyota 4Runner, they'd pay me $34,000 for the car. So I'm sitting there going, this is awesome, except I can't buy anything to replace it with. And plus, my daughter would be very upset because she's depending on getting that for her when she turns 16. But the problem is that even if I wanted to sell it, I got to buy something else. And everything else is more expensive than what I would sell my car for. So it doesn't even make a point of doing this. So, that's the challenge that we have here. But we may be seeing those used car prices now starting to peak. We're definitely seeing some depreciation now starting to occur in home prices. We're starting to see some impact in other areas where prices are starting to stagnate near recent levels. And all that's going to feed back into this inflation data. Maybe not, and again, as we'll talk about in a second, maybe not this month. This month we're still going to see high inflation data. But we're starting to get to that point where year-over-year comparisons are about to start applying some pressure. We'll be right back after the break. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
How do the richest people of the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife took my youngest daughter down to the pool store to buy a float. My daughter finds this one that's as giant as you can imagine. This float of a dragon. So it's got this big head on it, and it's got a tail coming out the back end. Of course, it's the biggest float they have.
The Real Investment Show podcast.
Yesterday morning, my Ring doorbell goes off. Here's my wife chasing the dragon down the street.
At realinvestmentadvice.com.
Dragons are real.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The most important insurance policy you'll ever own is the one you'll have when you die. Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income and protect your real estate. Thursday, May 12th at noon. Register now for the truth about life insurance at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, as noted this morning, it's going to be a little bit of a rough open out of the gates. Futures are pointing down about 1.5–2% this morning, depending on the index. And, you know, this is just kind of more of that ongoing selling pressure and negative sentiment that we've seen here over the last week or so. A lot of this just really kind of revolving around this whole concern about inflation, growth, you know, kind of, all that kind of just all rolled up into one. Of course, you know, what's happening between Russia and Ukraine, certainly not helping situations, but really this is more about inflation, valuations, earnings, outlooks, you know, these type of things. And, you know, and again, this is just kind of that point to where central banks are very late to the curve in terms of trying to mitigate the impact of inflation. Now, as we were talking about a second ago, we're about to enter this phase where markets are where the Fed's trying to increase interest rates to combat inflation. But now the year-over-year comparisons that we compare inflation to are now beginning to go positive. And again, when we take a look at the April data, this is going back to April of 2021. This is where inflation was really just starting to make a positive trend higher. And that inflation next month is going to be higher. And the month after that, it was higher. And the month after that. And of course, by this time, you know, by the time we get to January, February of next year, we're going to be comparing inflation to 7, 8, 9% inflation rates. So this is going to be a much harder comparison in the next year. So this is the big concern about inflation, that, you know, there's this real inflation, which is inflation that people deal with, and then there's the inflation measure that markets deal with. And there's the inflation measure that the Fed deals with. And that all kind of rolls into this monetary policy action that they're trying to do by hiking interest rates, tightening monetary policy, to try to quell inflation by slowing economic growth. And I thought Powell made an interesting comment last week saying that, you know, that he thinks that he can navigate a soft or softish landing for the economy. That sounds great in theory. Unfortunately, they've just never done it very well. And the problem is that the economy tends to move a lot quicker than what the Fed thinks it will. And it tends to happen kind of all at once when something buckles. And that's the problem. You can be looking at a situation in the markets and everything's fine, and then something breaks. And then all of a sudden it's not fine, and it's not fine very quickly. And that's the risk the Fed runs here, is they're trying to hike rates. And they're trying to do so in a manner that is at a pace that they think won't overly tax the economy. But at the same time, the things that they don't have control over, which is the biggest factor because 70% of the economy is the consumer. And this is where one of those reports comes up to where consumer spending doesn't slow down. It just kind of stops. And you have this very big contraction in the markets. And this is the risk they run. This is always the risk they run. And despite the fact, and again, we heard the same commentary from Ben Bernanke back in 2008. He said, hey, it's a Goldilocks economy, subprime's contained, everything's fine. And it was. I mean, the economy was slowing down. Yes, there were certainly some signs of stress. Yes, but there didn't seem to be any major cracks in the Fed's trying to hike rates and, kind of slowed the economy. And then all of a sudden, Lehman. And it was that one event that just broke everything. And that's the markets. It's kind of one of those days you wake up and all of a sudden something breaks. And you never know what's going to cause that. And it doesn't necessarily mean that that's going to happen this time. And I'm not trying to convey that message that says, oh yeah, one morning you're going to wake up and the market's going to be down 50%. I'm not saying that at all. What I'm saying is that this is the risk the Fed is running. Now, there's a lot of differences between our financial system now versus what it was back in 2008. We don't have the subprime credit. We don't have a lot of the other issues in the credit markets that we had back in 2008. You could say some lessons were learned, don't know. But there's a very different situation now. But is there still a credit issue out there that could weigh on the markets? Absolutely. And credit markets are a function of interest rates. And as interest rates go up, that's applying more monetary tightening. And this is really the kind of the key point here, is what supports economic activity is monetary looseness, right? Low interest rates, easy access to credit, people able to spend money as kind of they want, low inflation. That monetary looseness has been what's really kind of fueling the markets and the economy, over the last decade or so. Now, all of a sudden, you have high inflation, interest rates have gone up, wages aren't keeping up with inflation. So all those factors, and we're not even talking about the Fed here, just those factors alone are tightening monetary conditions in the markets and the economy. People their money just won't go far enough to make ends meet. That's deflationary because that's impacting consumption. So as we talked about before the break, there's already some signs on various levels that inflation, we may be at or near the peak of inflation. Doesn't mean we still won't have a fairly strong print of inflation come tomorrow when we get the CPI number. But this is going to be probably near that point to where we start seeing rates of change that are coming in weaker than expected. Now, the question will be, how does the market react to that? Don't know. We'll have to navigate that as we get there, but that's kind of the risk we run. So let's talk about markets here for a minute, because again, this is, kind of that point to where, investors start making emotional decisions, and this is where mistakes are made. One of the biggest problems or things that happens to investors is that markets are under a lot of pressure, and you wake up one morning like this morning and markets are down some more, and it's like, I can't take it anymore. I got to get out. I get it, right? That emotional pressure is big. It's a huge factor on individuals. But normally when you're starting to get that kind of pressure emotionally, that's normally where you are at or near at least a short-term bottom. And I know we've talked about this over the last week or so, but this has kind of been the point of where we are. Markets have been under a tremendous amount of pressure price-wise, a tremendous amount of negative news flow. Like I said at the open, markets in turmoil, those type of things. Those type of things typically occur at or near market bottoms, and it doesn't mean that markets can't go lower in the short term. They certainly can. Here's the challenge that you run into. Let's say this morning you just can't take it, you sell everything. Okay. The problem is going to be is that the markets are then going to start to reflex rally. And your first response is going to be, well, see, it's just a bounce. We've seen these bounces before. I'm fine. And then that rally is going to go a bit more. And then you're going to start to question your actions. And then the rally is going to go a little bit more. And it's like, okay, well, I got to get back in now because I've got to get my portfolio back to where it was previously. So I need to be in. So you jump back in the markets, and that's just going to be about right at the end of that reflex rally. And then you wind up on the other side of that trade once again. And that's just the way it works psychologically. And sometimes, look, there's nothing wrong with reducing risk in portfolios. Nothing wrong with that at all. And if you need to reduce some risk, then you can do that. But be wary of going to 100% cash to get out of the market entirely just because you can't take it. Because the problem then becomes getting back in. And there's a whole nother slate of problems that come along with trying to get back into the markets once you get out. And that's the one thing we caution on to a large degree. Look, markets are indeed under pressure. And that's just a function of what's happening in the markets right now. And again, this is about trying to make some right decisions. If we were at or near overbought conditions right now, then we could be talking about, sharply reducing risk, raising more cash, those type of things. But where markets are now, they are so extremely oversold. Sentiment has become so very negative on multiple levels that you're typically set up for some type of reflexive rally. And again, it doesn't mean that it's going to start today. Doesn't even mean it'll start this week. But sometime within the next few weeks, you're going to get a reflexive rally. And you can use that. Now, that reflexive rally may only get you back to where you are right now, right? But that would be a better place to sell than to sell today. So an important point about this is just try not to let your emotions override your longer term fundamental strategy and investment discipline long term. Emotions are our biggest enemy, and that's the hardest thing to control. So just be wary of it and factor that in to whatever decision-making process that you're thinking about this morning. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
How do the richest people in the world invest and protect their families? Richard Rosso and Danny Ratliff's next virtual Lunch and Learn on the truth about life insurance will show you how to insure your income, minimize your taxes, and protect your real estate. Thursday, May 12th at noon. The most important insurance policy you'll ever own is the one you'll have when you die. Register now for the Truth About Life Insurance Lunch and Learn at realinvestmentadvice.com. The truth about life insurance with Ratliff and Rosso. Realinvestmentadvice.com.
What worries you about your money? Enhance your financial success with RIA Advisor's free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab RIAadvisors.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. 6:45, we get ready to wrap up this first day of the week. Monday already. I think my weekend went by too fast.
Yeah, you're about 2 minutes slow.
Yeah, no, it's 6:48, actually, 3 minutes. I just kind of round it down a little bit.
Yeah,
make
rounding.
it easy. Yeah, you know.
To the nearest quarter hour.
Exactly. So, this weekend we had... So my daughter had her high school graduation party this weekend. Then we had Mother's Day on Sunday.
Mm-hmm.
I'm fooded out.
You're exhausted.
I'm fooded out. Too much food this weekend. Got one more graduation party and week after next, and then they're done.
So a double session in the gym today?
Yeah, easily, yeah. Yeah. No, I actually got a lot of good running in this weekend. So it was really pretty outside.
Yes, it was.
So my wife and I hit the sidewalk a couple of times this weekend.
Yeah.
So I try to moderate it a little bit, right? Try to match the exercise with the amount of caloric intake. So it was a couple of extra miles this weekend.
It's always a question of balance.
Yeah, I know. Whatever you want to do, there's a consequence. Interesting story out this morning. I was watching a clip of a horse race over the weekend where this horse that is long shot. I can't remember his name now. I'm totally drawing a blank.
I don't remember either, but I'm going to call him Lightning.
Yeah, he's in the very back of the pack. He's the long shot to win.
Yeah.
And they're in the final stretch, and this horse comes all the way from the back of the pack and wins this race. I mean, just amazing. And there's an important part about this, which Rich Strike was his name. That was Rich Strike. That was his name.
Very apt.
And, so the horse race announcer is, talking about, the leading horse and who's going to win and what's going to happen. And all of a sudden, Rich Strike comes out of nowhere and wins. And, pretty amazing. And the point about this is that there's lessons to learn from betting on horse. We talk a lot about poker and gambling on the show, and those it's very apt to investing because we don't really invest anymore. We all speculate in markets. We're worried about what's going to happen today versus what's going to happen 8 years from now. And hold times for equities back in the 70s and 80s used to be 6 to 8 years. It's now less than 6 months. So there's a lot of lessons to learn from poker and from blackjack and craps and just gambling in general. And there was an article out over the weekend that really kind of brought this into focus, talking about these very same things. Is like, the most important thing about investing is picking winners, and that's absolutely not the case. That's what we want to do. We're always trying to pick the winner. But the way to win long term is making bets that have the best odds of winning over time. And as an example, A horse that you handicap as a legitimate even money favorite should win about half the time, right? And so people don't want to bet on that because, I just don't get any reward for that. So a horse that wins about 1 in 4 times, as an example, if you bet it right, you're going to win more money, right? So because about 1 in 4 times that horse is going to win. So measuring and monitoring your bets accordingly is better because you'll make money in the long run. And this is really kind of the part about investing is that we often get too tied up with trying to win the short-term game, right? The market's up, the market's down, the market's up, the market's down. And we wind up, and this is what I was talking about a second ago, with our emotional biases, right? This morning, markets are lower. And big red banners right now on CNBC are on our monitors in our studio, right? Yields are rising, stock market sharp losses at the open, big red banners everywhere you look on the screen, and it's you take a look at it like, oh my gosh, I got to get out of the market. But again, as I said earlier, what are our odds of winning over the next 6-8 months with where markets are positioned right now? And if you get out today, that's completely okay. But what are your odds of, from these levels, technical, fundamental, these type of things? What are your odds of winning over the next several months versus being out of the market? And that's the part we've got to measure. And look, and these are all your own decisions. You have to make these decisions yourself. I can't make them for you. Nobody else can. But this is the analysis that we have to run and try to make assessments on normal historical statistical odds of certain things happening. And when markets are deeply oversold in very negative territory, historically the odds suggest that you're going to get some type of reflexive rally. And again, it's going to happen right after you sell. Guaranteed. The market does a very good job with this. The markets pressure people emotionally to do things at the worst possible time. And it's almost like they know, right? It's like, Brent sold, time to run up the markets, right? And that's why, this happens to everybody. It happens to me, it happens to you, it happens to everybody, right? We get in these emotional driven decisions, and sometimes you just kind of got to, just man up a bit, and you have to ride this part through, wait for the rally, and then make the adjustments. I'm not saying you shouldn't make adjustments. I'm not saying that you shouldn't do these things, but just try not to do them at points where your emotional stress is the highest. And see, the other problem then becomes because that when you do get this rally, it's going to come. It will, absolutely. No doubt about it. You're going to get a rally. And when you do, then the other side of this is going to be, well, you need to be selling, reducing risk, rebalancing portfolios. And we'll be talking about that here on the show. And you're like, yeah, but the market might go up some more, so I don't want to miss that. And so then you don't make any changes, right? And then you're getting on the other side of this emotional track, which is this extreme fear to extreme greed. But that's the markets. That's how they work. And that's how we have to try to navigate these things. And that's really just the point that we're going to have to deal with over the course of the next few weeks. And again, these turnarounds don't happen in the short term, but they do typically tend to happen. Do I have a? Is my if I play something here? Well, you can give me audio. I think I have that clip for the. For that race. Oh yeah. But it's about 54 seconds. But it's not cooperating with me. So, but anyway, if you do get a chance, take a look. It's Epicenter was slated to win, and then Rich Strike comes up. It's a pretty exciting, finish to that race. If you happen to get a chance, look it up on. It's everywhere right now. I mean, everybody's playing it, but it was pretty cool. Okay, last couple of things to wrap up this morning. Quite a few. We're getting ready to kind of wrap up the big influx of earnings, and we've gotten through a large chunk of the S&P 500 today. We've got Palantir Technologies, Coty, Duke Energy this morning reporting, Tyson Foods, Blue Apron. Keep a watch on Tyson Foods. They're expected to report earnings of about $1.90 a share. That's going to be kind of a good inflation gauge. What's going on with chicken? Is after the bell, we've got Plug Power, Novavax, Simon Property Group, a good kind of bellwether for real estate. Real estate under a lot of pressure last week and has gotten pretty beat up here, along with several other of those sectors. Zynga, Vroom, Lemonade Inc., which is an online insurance portal. And I like watching this one because, again, we're seeing a lot of these companies, these apps come up, and it's like, oh, you can now do everything online. Isn't it great? Uber, Lyft, a good example of this. Isn't it great you can do all this stuff online? These companies just cannot turn a profit. Even Lemonade, which is selling insurance, is reporting losses of $1.42 a share on $43 million worth of sales. For moving in that direction, it's interesting to see that we can do things more conveniently, but these companies cannot turn a profit. And at some point, they've got to start making money. Uber was a good example. Over the weekend, they announced that they're going to start treating hiring. If you want to be an Uber driver, it's now a privilege if you get hired by Uber. They're going to start treating hiring as a privilege at Uber. Lyft is having the same problem. All kinds of incentives to get drivers and things like that, eating into profit margins. But the burn rate on these companies is massive. And as we said, as we talked about previously, the term Uber is now ubiquitous for Lyft, getting a taxi, renting a limo. It doesn't matter what it is, right? It's like, oh yeah, we can just Uber over there. It doesn't matter how you actually get there. I'm going to take a train, but I'm going to call it an Uber. It's just that has become a ubiquitous term for ride sharing and almost, just pay for transportation, but they can't turn a profit. It's pretty interesting. All right, wraps up the show for the day. Get by the website, realinvestmentadvice.com. On our simplevisor.com this morning, if you want to check it out, we have a new sector analysis report that I just posted this morning, going sector by sector with entry and exit positions for every sector of the S&P 500. That's at simplevisor.com. If you're not a member there already, you can subscribe for a 30-day free trial. Check out all of our analysis and statistics and things that we have there on the website as well. Do your own research for your own portfolios. That's at simplevisor.com, along with that special report. We'll be back tomorrow morning for the next edition of the Real Investment Show. Stick around. 3 minutes on markets and money coming right up.